We can start.
Yeah, that's good. Just really switch screen. Okay, great. Hi, everyone. Welcome to this discussion hosted by the Center for Science and Environment on the Baku to Belem Roadmap and the larger question of where we move on the question of climate finance for developing countries this year and in the years to come. I'm Avantika Goswami, and I lead the climate change program at CSE. And I have with me an incredible panel of what I like to call some of my favorite voices, very critical voices coming at the climate finance question from diverse perspectives. I'm sure all of you are also looking forward to hearing from this great panel. So before I hand over to them, I just want to kind of set the context for why we are having this conversation. Why now, why today? As many of you may be aware, at COP29 last year in Baku, Azerbaijan, the world agreed on a new climate finance target, which was a follow-up to the previous climate finance target of $100 billion per year owed from developed to developing countries. The new target essentially enshrines a large figure of $1.3 trillion, which should go towards the climate needs of developing countries. But the details are fairly vague on who will pay into this money and what are the sources that will also provide this finance. Nested within the 1.3 trillion, a figure of 300 billion was agreed, on which developed countries would take the lead in provision to developing countries. Now, for many spectators, this was a successful outcome of COP29, given that it was already a tense political environment last year. But from the perspective of developing countries, civil society like us, it was overwhelmingly a very, very poor outcome. It was far below the needs and demands of developing countries. So the last demand that the G77, or the largest bloc of developing countries, had made in Baku was for $500 billion of public money from developed to developing countries, nested within a larger $1 to $1.3 trillion target. So getting a vague target like the one that we finally secured in Baku has put us on a pathway of huge uncertainties going towards 2035. Who is accountable for paying this money? What are the sources it will come from? Will it be highly concessional finance, or will it be market rate debt that will worsen the debt crisis in many countries? Many of these questions remain. So adding to that, coming to 2025, we are seeing a much more topsy-turvy geopolitical environment. And I won't repeat some of the things we already knew going into Baku. We already knew that climate finance was inadequate. We already knew that renewable energy investments in the poorest parts of the world were highly inadequate. We already knew last year that there was a burgeoning debt crisis. So UNCTAD is on the panel, and UNCTAD's data has shown us that 3.3 billion people live in countries that spend more on debt payments than on education or health. But adding to that, in 2025, we are seeing massive cuts to foreign aid or development assistance, anywhere between 20 to 40% from developed countries. Not just that, we are seeing changes in the foreign cooperation strategy of many countries. So I want to highlight a quote from the UK Foreign, Commonwealth and Development Office at the spring meetings this year of the World Bank and IMF, where they said that the UK aid is likely to shift from donor to investor mode, from service delivery to supporting governments better spend their own money, from grant giving to information exchange. So it's a changing nature of international cooperation that we are seeing this year. You add on additional pressure like the threat of new tariffs, which could hurt the export earnings of highly trade-dependent countries, particularly in the developing world. You add on pressures like carbon border adjustment mechanisms, which could essentially pass on the cost of decarbonization onto developing countries. All in all, you're seeing an even more difficult landscape this year for developing countries to cope with the climate crisis and to pay to both mitigate and adapt to climate change. So I wanted to put together this discussion to have some of these voices help us sift through these complexities and maybe help us identify. So I haven't been very hopeful this year on climate finance, but I'm really looking to some of the experts here and my colleagues to help us identify some possible windows of opportunity, maybe some specific points of impact where we can actually focus our efforts and really ensure that this question of funding decarbonization in the developing world isn't completely lost in this geopolitical storm that's ongoing. So I'll stop here and I'll introduce our first panelist for today. So we have Ms. Chandni Rena from the Ministry of Finance in India, and she was a key part of India's delegation last year at Baku. So Chandni ma'am, would love your reflections on whether or not the Baku decision puts us on a viable pathway to scale up the provision of climate finance in line with the Global South's needs. Welcome to the panel.
Thank you so much, Avantika. Am I audible? Thanks. So at the outset, I would want to appreciate this initiative of Center for Science and Environment in bringing up this discussion on the Baku to Belem Roadmap of $1.3 trillion. I think this is a discussion which will see a lot of reflection on in several formats as we are now understanding the way in which this discussion is going to move forward, led by COP30 presidency. And therefore, I think fleshing out some of the issues is important. We must remember the context of this work, the Baku to Belem program. You asked me whether NCQG was a good outcome or a bad outcome. I think we have already made a statement, and it's there for everyone to know that it was indeed a very small amount that we agreed to, or we could agree to, which is indeed insufficient to meet the needs of the developing countries in terms of climate action, especially considering their own NDCs and considering also that we need them at concessional rates. The estimates itself run into several trillions of dollars, and that became the fact that the goal itself was so small became the reason for this added part in para 7 initially, which says we call on all actors to help mobilize $1.3 trillion to finance developing countries' climate action. It is a call on all actors, so effectively it means a call on MDBs, it's a call on the private sector, the public sector as well, and the domestic resource mobilization part as well. So it's actually effectively asking, including the fact that developing countries should shell out more for climate action, substantially more, to be able to enhance their commitments and to meet their actions. Now, it is an attempt, I would see, from the decision to try and address this big gap that exists. 300 billion vis-a-vis, I think there was a demand for 1.3 trillion on the whole by the developing countries on an annual basis. What was agreed was 300 billion per year by 2035. So it's not by 2025, but it's by 2035, which means that we would continue to ask for 300 billion till perhaps around 35, when there would be a time when hopefully things would come in at about 300 billion, far short of what we actually need. because if the requirement is 1.3 trillion per year, it's stacking up. And if action is delayed, then perhaps the requirements enhance even more later on. So there is a concern that we had. And perhaps to address that concern, there is also a paragraph that talks about this Baku to Belem roadmap, and it kind of says that, well, we will look at it and see how we can expand this overall mobilization to 1.3 trillion. And to that extent, I think I can only, feel that this is an important work of the presidency. How it finally arrives at will depend upon the buy-in of the developed and the developing countries to the recommendations that come out of this kind of work of the presidency. And now, I would want to bring out certain factors that I consider important when you're looking at a goal of 1.3 trillion. And why is it so? Is some of the aspects that I want to reflect on. Now, it is imperative to underscore that concessionality and adequacy of climate finance is absolutely vital for meeting the climate actions that we have set out to do, right? Developing countries are facing disproportionately higher costs. And there are several reasons for it, including the fact that our credit ratings are, the methodologies of credit ratings are opaque, and the credit ratings of most developing countries result in high cost capital. So if the money is going to come from the private sector, it will be high cost. It will be high cost, implying that the kind of action that is possible, the scale of action that is possible by developing countries will be limited by the cost. It's fairly simple economics. I mean, no project works at a high cost if it is not going to be viable at that high cost. And we all know that climate projects tend to be more, risky. They are new technologies. They are technologies that have not been implemented unless, of course, you want to do solar and solar and solar, but not solar and battery storage, which is the more, reliable source of energy. And we've seen what has happened, or do all of that and no investments in the grid, which we've seen what happened in Spain. And we've also seen the developed countries facing high electricity and high energy costs, primarily because of, trying to stream in climate technologies that are not, that are high cost, and they require subsequent investments. For countries, developing countries, the cost of capital is far too high. So it limits the availability of avenues for investments on climate action. There is also the case of limited fiscal space, because there's already, as you mentioned, about the debt vulnerability in many of the developing countries. Besides this, there are several developmental priorities that they have to still achieve. There are the SDG goals that are, beyond climate action, that have still to be achieved. And there is the tightening global economic condition. You mentioned about how the situation on the, the world economy is also not getting any better. Now, if with that in view, what is perhaps that we need to address is the implementation of Article 9.1 of the Paris Agreement. Now, this is one article of which hasn't been implemented at all. What does it say? It says developed countries shall provide. It's a mandatory commitment of the developed countries to provide. It's important that there is a provision goal. The reason why there is need for a provision goal, at present, the NCQG doesn't talk about a provisioning goal as such. It is more like a mobilizing goal of 9.3. There is a need for provisioning because it is the provisioning that kind of catalyzes the private finance. Private finance is not going to give up. It is not philanthropic that it would say that it can exist with low costs, low returns. It would still want those returns. And so how do you match that? How do you reduce the cost? You bring that portion, some part of it comes in as a public sector funding support, maybe concessional, maybe equity participation, maybe a grant element. There are several ways in which it can come. And then only together would it form a, reduce the cost enough for climate action at scale by the developing countries. So this is one article which we feel is central to the discussion on climate finance. And unless, of course, the climate action itself would then otherwise suffer. So reliance on private sector mobilization overlooks these concerns. And therefore, that there is sufficient, perhaps, there is discussions about how there is sufficient mobilization, sufficient finance available in the private sector. There may be sufficient global capital, but that sufficient global capital is only going to the developed countries. It's not coming to the developing countries. If you look at the biennial flows that the Standing Committee on Finance came out, it says that almost more than 90% of the resources are actually flowing into the developed countries for climate action. It is not coming to the developing countries. And the reason is exactly this, that there is the problem of high cost projects, high capital costs, and the problem that climate requires, it adds up. Now, there is also this discussion about MDBs, and I think MDBs have an important role to play. NCQG mentions the role of MDBs, but what is more important is that they need to scale up. So MDBs at present, in the present juncture, cannot mobilize the kind of finance we need for 1.3 trillion. We need the MDBs to scale up, which means that the shareholders have to scale up on capital, right? And who are the shareholders? So there are the developed countries and there are the developing countries also. And because it's a shareholding across the whole set of all of our countries. Effectively, it is greater contribution by all, and of course, more effective utilization of the resource as well. That is making it better. But this requires a decision at another fora. So perhaps the Baku to Belem can speak about it, can push this, but beyond a point, it might be difficult for it to get anything out under the UNFCCC and the Paris Agreement process. We have to understand that while we do that, MDBs have a greater role also to play for meeting developmental objectives. So that it should not happen that the development finance or developmental priorities suffer on account of climate action also by them. So if we restrict the finance available from MDBs to what exists at present, then it is going to, and if there is a shift to climate action, then it does impact access to developmental priorities, which is something that most developing countries find hard to accept, because that builds resilience, and resilience is important in the face of a situation where we breached 1.5 degrees last year. So in a situation where climate is becoming increasingly, we don't know, unstable in terms of the weather events that we are seeing. So caution has to be exercised to that effect, that we cannot categorize all development financing into climate finance. So there should not be any greenwashing. It should not be that development financing by MDBs then gets regarded as somewhat as climate finance, because that is something that will impact. What the UNFCCC can definitely, the process can definitely do, is to address the scaling up of action by its own operating mechanisms. So the operating entities, the financial mechanisms of the UNFCCC, which is the GCF and the GEF, and the Fund for Loss and Damage that has been created after COP28, and their funding should enhance. The pledges need to come in, and their effectiveness also is an area that needs attention, because finance flows from GCF have been problematic to developing countries. The access to resources is not as efficient as it should be, as good as it should be. There's a lot of discussion I saw on regulatory reforms and harmonization. So when you bring in the private sector, you want to also have regulatory reforms that that reflect the present situation in developed countries, in countries that are completely out of sync with your own reality of developing countries, with their own country circumstances, very different from that of the developed countries. Now, we have a fear that this kind of harmonization may actually hinder the flow of finance than encourage it, than enhance it, because the regulatory measures always follow or need to be in sync with the country's own circumstances and their priorities and the industrial structure, the economic the markets that exist. If it isn't, if it is seeking something that doesn't exist, then it impacts investments as a whole in the country. And that is something, again, it would be a little difficult to accept. So if the discussion on Baku to Belem is on regulatory processes, then it is actually domestic resource mobilization that they're talking about. Basically saying that you do this, you set your house in order and finance will flow. Unfortunately, it's not happening because the emerging market economies are not getting resources also. So it's not about only about all the developing countries, but even those that are doing well are not getting those financial flows because the situation is not the same. The contexts of the two countries, like the advanced economies or developed economies and those of the developing countries, are very different. Another thing that is important is that when we're looking at climate finance, it should be in the context of national circumstances, priorities, and context. So always finance has to flow in to actions that countries themselves determine as important. And in this regard, adaptation is an equally important role for us, for developing countries, because we need to build our resilience. So finance needs to flow to adaptation as well, and at a fairly concessional rate, because that adaptation is usually not financially viable at all. So the pace of energy transition, the kind of actions we take would have to be in our contexts. So, and I would end with this, that the UNFCCC and the Paris Agreement very well note the fact that climate action needs to be led by the developed countries. They also note that climate finance is also something that the developed countries need to play a dominant role in to enable finance flows to developing countries. And it's not for any reason, but for what I've just discussed a little while ago. Collective action, I think, and Baku to Belem will depend upon collective action. And that alone can build trust and help us achieve the objectives that we seek to achieve through our multilateral environment climate treaties. So I'll end at that. Thank you so much for inviting me.
Amazing. Thank you so much. And also just want to highlight that India did make a submission towards the Baku to Belem roadmap, as you mentioned. So a lot of this is also reiterated there. And but thank you for kind of bringing this to the discussion, covering so many crucial elements. I think Article 9.1, the question of high cost of capital, which has really elevated in the climate finance discourse over the past couple of years due to, I think, massive efforts from developing countries, but needs to be much more front and center. And also this question of what the UNFCCC can and cannot do. It brings me to a convenient segue, actually. So the UNFCCC is tasked with agreeing upon this climate finance goal, which was set last year. And within that, the Baku to Belem roadmap this year is trying to envision how that finance goal will be achieved. But there are interlinkages with many other fora. So the MDB platforms, the G20 processes, the BRICS convenings. So I'd like to bring in Katie, our colleague from UNCTAD, to comment on how some of these other spaces are kind of interacting with this question of the Baku to Belem roadmap, and what is the potential that they have to help us towards the achievement of this goal. So Katie, over to you.
Thank you, Avantika, and thank you to CSC for inviting me to participate today with this fantastic panel. You do such fantastic work. I suppose in this context, multilateralism would be the word I would want to underline here as the crucial tool that we need to overcome the challenges that we're facing with financing, especially when we know the limitations of focusing only on domestic finance flows in developing countries when you compare what their capacities are to the scale of the challenge. However, we are at a juncture where multilateralism is under mounting pressure, faced with the geopolitical crises and eroded trust, as you've mentioned, Avantika. For example, 2025 has seen a huge retreat in support for sustainable development from donor countries. I want to underline here that ODA plays a really important, crucial role, particularly for economies that are vulnerable when alternative funding is limited and shocks like natural disasters or war can easily destabilize their development trajectories. Yet, of the 17 biggest DAC donors, who account for 95% of total ODA, 14 of them are reducing their ODA budgets, which amounts to over $30 billion in cuts. So I think that in this context, this is really important to sort of frame the direction that we're going at. So I would urge people to continue to stand up for multilateralism, to defend its principles, and to argue for more balanced outcomes that truly reflect the challenges that every country is facing in climate and development, with the particular constraints that developing countries face. And this includes maintaining a really high level of ambition and the sort of multilateralism that we want to see, in order to not fall prey to a pessimism of possibilities or to lower the bar for what countries can achieve together. And so to that end, I think the UNFCCC is obviously an important starting point for talking about climate finance, but it isn't the end of the road, as you sort of were mentioning there, Avantika. While the NCQG outcome was far from satisfactory, as has been discussed already, the roadmap itself is not mandated to be attached to any outcome on finance, but it can still function as a high ambition signal and an implementation framework for trying to rapidly scale up climate finance in line with CBDRRC equity and the other principles of the climate regime. If the roadmap can outline concrete, actionable measures, define indicators to track their progress, clear roles and responsibilities, and time-bound milestones to aid the implementation, it can be a really important tool for observers and parties to scrutinise the actions taken to enhance climate finance flows and build traction and momentum towards them. And now this goes for inside the UNFCCC and outside. So I think this sort of role that the roadmap can have as this indicator and tool for scrutiny could be really important. Obviously, within the UNFCCC, we might see an outcome on 2.1c this year, which has some challenges with upholding CBDR. But to that end, there is a role for 2.1c to play in redirecting flows from highly emitting activities, particularly from the financial institutions in developed countries where we see the majority of finance flows going to high emitting activities, into just transitions developing countries. I think Nadia will speak further to that, so I won't go too much further into 2.1c. Outside of the UNFCCC, and a really important multilateral space this year will be the 4th Financing for Development Conference, which is of course focused on development finance, but has implications for climate finance too. This is happening in a few weeks' time at the end of June in Sevilla. While no one could have foreseen that this much-awaited conference would be taking place in a context of retreat from development cooperation, we still have to use this opportunity to highlight the systemic reforms and transformations that are critical to unlocking more reliable, suitable financing for both development and climate initiatives, including the need for an effective workout process for debt restructuring relief. You mentioned the sort of statistic from UNCTAD, Avantika, and I just want to emphasize that it's not total debt payments, it's just the interest on debt. So 3.3 billion people live in countries that are paying more on interest than on health and education. So how countries are supposed to be able to tackle climate when they can't afford their education and health budgets is a massive constraint. Within the FFD text at the moment, climate is quite thin and it's not strongly mainstreamed. And it is challenging to achieve this in the current context when we have a high degree of double counting, where the need for more financing for both climate and development leads many donor countries to overcount their contributions, erodes the effectiveness of official assistance, and puts downward pressure on overall support. So it's understandable that there would be a fear of bringing climate too much into the financing for development space. And in this respect, I think pushing for greater integrity in the links between climate and development finance would be a really helpful outcome from this FFD, which is currently under paragraph 34 in the text to form an intergovernmental working group to enhance consistency and transparency of ODA and climate finance reporting. So that could be an important area for further integrity to these finance flows and to avoid this double counting pressure. Overall, the current FFD text could also have a stronger narrative and vision for the development this financing is for. At the moment, for example, structural transformation is not mentioned once in the text. And it's really important that this document connects and responds to the material reality that developing countries are facing and the urgency of this moment. We shouldn't fall prey to having proposals that are both means and end. For example, advocating for more trade without talking about what kind of trade we want, or advocating for deeper financial markets with no clarity on the sort of development that that might lead to. So linking proposals with the development needs is really important. You know, it's worth reinforcing that this text is likely to be a decade-long reference point. So while many ideas might not be ripe for this moment, we should also attempt to include aspirational ideas that could be picked up in the next 5, 6, 7 years. And to this end, I also want to mention UNCTAD's own conference this year. We will have our own 16th quadrennial conference where member states will agree our mandate for the coming 4 years. At the last conference in Bridgetown, we received a stronger mandate from member states to work on climate issues. And member states will get the opportunity at our conference in October to strengthen this and allow us to work more deeply on climate issues as they relate to development challenges. You also mentioned the G20, and G20 is, of course, not a multilateral space, and it can't be representative of the full spectrum of countries and their experiences, especially those countries that have got challenges in accessing adequate and suitable climate financing, like LDCs and SIDS. However, it has in recent years been an important space for testing ideas, for initiating difficult conversations and initiating dialogues between North and South, the major systemic economies in North and South on issues related to climate finance. For example, last year, under the 2024 Brazilian G20 presidency, we saw the G20 roadmap for bigger, better and more effective multilateral development banks. We also saw the task force on the Climate Task Force, and we also saw proposals for the climate vertical funds to improve their activities. At South Africa's G20 presidency this year, they have a cost of capital commission, so related to what Chandni was talking about, the challenges of high and expensive costs of climate finance. And they have also made it a high priority to increase support, financial support for transition and climate shocks. However, at the same time, and considering that this is not a multilateral space, I think that we should be cautioned in what we can expect from the G20 processes in the coming years. And while this can be an important space for initiating these conversations, ultimately, they need to be transferred over to the multilateral space. We see the challenges when conversations take place only in the G20, for example, around debt workout, that doesn't get extended to the countries who might be actually on the front line of some of these crises. Similarly, BRICS is not a multilateral space, but on the other hand, it is a space for developing countries, now inclusive of Brazil, China, Egypt, Ethiopia, India, Indonesia, Iran, Russia, Saudi Arabia, South Africa, and the United Arab Emirates, to focus discussions on developing country concerns and the actions that they can take together to decrease their exposure to the shifts in policy in Annex II countries that we're seeing at the moment. South-South solidarity and cooperation are critical to overcoming development and climate challenges that persist as a result of the deep structural asymmetries that we've been talking about in this event today. And as major economies, BRICS comprise about 48% of the global population and around about 28% of global GDP. They can play a really important role in driving this and being leaders on this. Only last week, last Wednesday, a framework document on climate finance was approved at the BRICS high-level meeting on climate change and sustainable development. And this document is planned to guide common and collective action by BRICS countries in the area of climate finance, for example, on MDB reform, increasing concessional financing, and other regulatory issues and alignment between BRICS economies to enhance climate flows, not just within BRICS economies, but also to wider developing countries. So this outcome on climate finance in the BRICS was alongside other outcomes, for example, on green technology, climate and trade issues, and carbon accounting. And while this is no replacement for a strong multilateral outcome and for developed countries upholding their commitments and for upholding the outcomes of the Paris Agreement, ultimately, South-South cooperation has proven to be resilient through the turbulence that we've seen in recent years. And these outcomes show the key role that a forum like BRICS can play in developing solutions and concrete proposals for the South from the South. So alongside advocating for commitments and principles to be upheld in our multilateral institutions, we can also encourage these South-South forums to innovate and build resilience together. There's more that I could say, but I'll stop here for now.
No, that was great. And I think you answered a lot of the questions that I think have been emerging in terms of there are limitations of spaces like the G20 and BRICS, but there are also certain characteristics like a lot of the economic governance issues are discussed at G20. And as you said, they've kind of tested a lot of those ideas there, which do have relevance for what's happening within the UNFCCC. But of course, we always have to come back to a place where the principle of common but differentiated responsibilities, the voices of all nations, consensus-based decision-making, all of that is also upheld. So yeah, very sort of fascinating to see the offerings of the different spaces towards this larger discussion. I'll now pivot a little bit. I think what what we have been reflecting on to a large extent is the disagreements and agreements that are happening at the very, very high level at the UNFCCC need a stronger connect with what's happening in the subnational context and even right down to the project level or individual entity level. And for that, I've invited one of our good friends, Sangeet, who is at NSC. I'm really keen to hear from a sector expert like you, Sangeet, in terms of when we say that developing countries face multiple barriers to inflows of finance. One example being, let's say, borrowing costs being something like developing countries facing 2 to 4 times higher borrowing costs than that of the US or 6 to 12 times higher than that of Germany. And these are, again, UNCTAD numbers I'm citing. What does this actually mean? And can you shed some light on some of these barriers, which really necessitate a deeper reflection on why we were demanding a better, more transparent, more accountable goal in Baku? So yeah, Sangeet, would love to hear from you.
Thanks, Avantika, and thanks to the Center for Science and Environment for inviting me to speak on this. So I think I'll get to your question, but I think what's helpful is to maybe just take a step back and say, what kind of finance are we talking about here? Because I think the ask, I think this is something that was reflected in the Baku negotiations as well, is the expectation was the 1.3 trillion will be grant, but really it turned out that the question was about it's going to be 700 billion of private finance and a few billion of public and a mix of other things. So I think in terms of what are the finance flows to emerging market developing economies, I think it's helpful to just maybe separate out the different types, right? So I'll just give some headline kind of numbers in terms of where we are, and then I'll get to what you're asking about, Avantika. So if you just take the entire financial system, right? So if you take total global assets, according to the Financial Stability Board, there's about $500 trillion, right, in the financial system. Right now, this is including non-bank financial corporations, banking institutions, public finance institutions, central banks, right? So it's in the late 400 billion trillion mark, right? So let's say around 500 trillion. Now, of the emerging market countries that data set includes, right, about 5%, 4 to 5% of those assets reside in emerging market developing economies. And if you look at a country like India, only 1%, right, of this overall asset base is in a country like India. Right. So I think it's important to acknowledge where we're starting from in terms of when you say domestic resource mobilization, there's only so much you can do, right, in terms of where this capital is and where it's going. So I think that's just the first order effect that explains a lot of the critique that's come out when we're talking about investments needed in the climate context. Now, I think if you just separate out the public and the private kind of spending, right? So if you just looked at some of the MDB spending, right? So let's just take a few MDBs and see how much they kind of lent total in 2024, let's say, right? So it's before some of these more recent cuts and some of the headwinds we're facing. So I'm talking 2024 numbers. So the World Bank lent in total, so that's World Bank Group, about 120 billion, right? That's everything that they did. About 40% of that was climate, right? The ADB lent about 24 billion, right? The AFDB lent about 11 billion. So, and this is for all their total lending, right? So it's a very, very small amount in comparison to the numbers that we're talking about in the needs. So, and of that, this is not just climate, it's health, it's other things. It's some of that is commercial, some of that is grants, some is equity. So it's a whole mix. Now, and that is a lot more than they were doing before, right? So I think at the 2024 number, the charts look something like this in terms of how much more lending they're doing than they ever did before. Do we need them to do more? Yes, right? But I think let's see where we're coming from. On the private side, if you look at the breakdown of the different kind of inflows or outflows into emerging markets, developing economies, excluding China. So when I'm talking EMDs, I'm talking excluding China for all these kind of statistics. There has been a net outflow from public markets, right? The trend line goes down for public equities, public debt in the last 10 years. And COVID exacerbated that. So if you look at kind of overall outflows from public markets, that's what's happening. And so that's, I think, something to acknowledge. On the foreign direct investment, there's a slight kind of upward trend. And this is something, if you're more interested, I point you to kind of the OECD monthly capital flows data set, right? So it will show you where some of these capital flows are coming. Now I think let's move to climate, because I think it's helpful to understand where are we. This is global flows. This is what's happening in terms of finance that's flowing to emerging market developing economies. Now, if you look at climate, the Bloomberg New Energy Finance tracks investments into all clean investments globally, right? So last year they said in 2024 that total investments were something like $2 trillion USD in all clean energy, clean investments, not just clean energy. And then the two EM countries that are really included in that are India and Brazil. And if you look at that, India's got about 47 billion, up from 32 billion the previous year, and 37 billion for Brazil, up from 34 billion the previous year. Right. So that is kind of what's currently happening in terms of investments, and most of that is domestic resource mobilization, right, today. So I think this is important to acknowledge, and this is something that's borne out by the data time and time again in different forms. You can look at the IFC kind of capital markets growth report, right? It's all mostly domestic resource mobilization that's kind of brought us to where we are in terms of flows today. So now I think talking about what does it mean in terms of why are this cost of capital is high, right? And finance is not flowing for projects, and therefore the ask. I think it's easier to take instances of actual kind of sectors, I think, to maybe illustrate. If we thought about cash flow projects, right? So now I'm going to talk just private finance. We want private finance to come in from international investors, right? Equity, debt, FDI, whatever, right? To come to projects that have cash flow. Let's take renewables, right? There's kind of three types of risk that project finance generally deals with in a way. Right? Again, I'm simplifying here, so others as well, but if you kind of put them in broad buckets, right? There's technology risk, right? Is what I'm giving money to something that's a tried and tested technology, right? Is there some data to kind of show how long this will last, etc. Right? Can I model that into looking at what my cash flows would be? Right? There is, if you're selling something, right, is there off-taker risk? So in the case of renewables, you're selling power. Will the person who's selling this power get paid on time? Will they ever get paid? Will they be able to pay me back? Right? I think just kind of that would be one bit. And the other bit, when you're coming as an international investor, is risk of the currency. Right? I think this is kind of the foreign exchange risk, because you're coming in another currency. If I'm lending for 20 years or 25 years, will I know in 25 years where this currency will be? Because I will want my money back in the currency that I'm lending in, and I have to convert that back in 25 years. And so many of these things combined, right, become oftentimes the country credit rating risk, right? Not all the time, right? But I think there are pieces of this that go into what is the sovereign credit rating, which forms the basis for an international investor to lend, right? Because it determines whether your junk status, investment grade, high investment grade, etc. Now, within, I think there was a allusion to the credit ratings that emerging market countries face, mostly by developed market credit rating agencies, and there's a lot of disparities there. Oftentimes, you'll find a credit rating agency that's got it's a division in one of the emerging market countries that rates the same debt as AAA, meaning it's the best possible, and the New York headquartered parent of the company of the same company will rate the same debt as just about investment grade or junk status. So there is, what are the methods that you're really thinking about when you're rating this? I think this is a real question. However, right, there is a risk. I think that one has to acknowledge that there is is there an accurate pricing of the risk is the question to be had, right? Is the perceived risk, right? This is the famous kind of two words that keep floating around in this space, right? An accurate reflection of that. And there are norms and conditions around how these ratings happen, right, that we should discuss, and we should find ways to break. And I think that is work and that requires cooperation from emerging market, developing economy governments, right, to really engage these credit rating agencies to say, this is what we'll be able to show, right? Because asking the governments of developed markets to ask the credit rating agencies there to do better is not, I think, the right counterparty to be able to have that conversation. It is something that you have to engage the credit rating agencies on directly, right? And I know governments have been trying, and it's been part of a long-standing issue that's outside of climate at large. But I think it's particularly important in the context of climate for the many reasons that have been said before. So I think that's something to continue and illustrate, and part of that will be, right, things around regulation that have increased some of the risk statuses. So I think that's maybe one part of it. Now, coming to maybe just kind of the last bit, I'll say, is on the three buckets of risk that I laid out, kind of, that when you're thinking about in project finance. There is very little most emerging market developing economies can do about forex risk, except for good macro. It's unfortunate, but I think that's the reality of where we are. It's a risk that doesn't go away. Someone has to always, some part of the financial system, right, will have to sit with that risk on their books, because of just how macroeconomics works in a way. So, but there are ways that people are thinking about how to minimize that, or who should sit on some of that risk. And within that, right, I think it's important to differentiate different types of countries that face this kind of forex risk, right? So there's countries called the L2 countries, right? So that's countries like India, Brazil, that have sovereign bonds that they've issued for 10 years, etc., which gives you a bond curve that goes a couple of years out, which helps, at least gives you the theoretical swap price, right, that you can hedge your currency on. So there is a swap market for at least up to 3 years in India, in Brazil. There's other countries that issue sovereign bonds, but for much shorter time period. So you have to entirely create a new method for how would you price something like forex risk and get on the swap market. And then there's countries that don't issue sovereign bonds, right? This is not something that they do. And so this fundamentally makes it challenging, right, to kind of hedge. There is no market instrument out there to be able to hedge that risk, even at whatever cost, right? So all these instruments come at costs. But what is it that then in that group you do, right? Now that's the endeavor of the Currency Exchange Fund, right? They were set up to do this. Essentially, they work mostly with multilateral development banks to enable and development finance institutions to lend in local currency to their client countries. Right? Now we need to think about what that means for being able to do that for private clients and others if we want to really think about what this challenge, if we want to deal with the Forex challenge, right? To at least create the market that the country can actually go out there and hedge some of that risk. Now, the other two bits on the technology and the off-taker or counterparty risk or so, there's been lots of examples of kind of many emerging market developing countries dealing with that head on and attracting a lot of investment. I think the prime case is renewables in India. SECI was set up, the Solar Energy Corporation of India was set up essentially to take off, to essentially give all renewable projects the sovereign rating, right, in terms of a credit risk versus much poorly rated firm discoms or utility companies in India. And so I think there are ways to think about policy and dealing with that bit of risk, right, that helps private finance flows come in, and renewables is again onshore wind and utility scale solar are the two examples of that in the context of India. And then technology risk, again, I think it's something you need the technology needs to be mature, right, to be able to see where that goes. And the renewables is again the case for that. In instances of, steel and other sectors that are, that are known as the hard to abate sectors, the technologies are in question. So I think that's when private finance will find it harder to come and fund a lot of the projects, and that's where more and more public support's needed, and most of that public support is going to projects in developed markets. We've got some forthcoming work that tracks all kind of state support to green steel projects, and it's all in developed markets, and it's in the billions and billions and billions of euros and dollars. So I'll stop there. Maybe that gave a good overview, but I think that's how I would, I think that those would be the challenges. That's kind of why finance is not flowing, and these are the things that we can start to think about. And I think in this context, I understand the concern of going back to emerging market developing countries and say do more domestic resource mobilization, but I think that's going to be a big part of how we deal with the next couple of years. And I think there is a lot of scope for much greater domestic resource mobilization for climate in many emerging market and developing countries.
No, that was super helpful, Sangeet. Thank you so much. And I think it really also does reveal, I think these are some conversations we had even last year leading up to the NCQG, that different developing countries are positioned differently. Some face a higher level of such barriers, some are slightly better positioned, India, for example. So I think that nuance is important to kind of take into this entire calculus. And also some of the, I guess, forward-looking solutions that you were also discussing. Thank you for that. I now switch to our last, but definitely not the least, one of our great panelists, Nadia. I'd like to welcome you to actually speak to a slightly different angle of this whole question. So there's, of course, within the UNFCCC, there is a separate track which is looking at how money can go less towards polluting activities and more towards green activities. So roughly under the umbrella of Article 2.1c of the Paris Agreement. But I think there are a lot of concerns and questions that developing countries have around Article 2.1c, which I won't get into right now. I am curious, though, in this effort to shift billions or trillions into developing countries to help them with their climate needs, how do we reckon with the billions that are actually going into fossil fuels, a lot of which are taking place in the developed world? So I think this is IRENA's data, which showed that the North American region alone, and this is data from a couple of years ago, comprising of 3 countries, the US, Canada, and Mexico, spent 4 times as much on fossil fuels as it did on renewables. So how do you kind of, I don't know, change these incentives and mechanisms to see some of this finance flow towards decarbonization and climate, particularly in developing countries? So yeah, I would love to hear from you.
Yeah, no, thanks a lot indeed. I guess really it's really important the conversation we're having today, where we are all here really to reflect on where we go after Baku. But I really want to start with a very simple concerning fact. That's exactly what you just fleshed out and highlighted. It's really, despite the urgency of the climate crisis, actually capital is still flowing way more towards, unfortunately, fossil fuels rather than climate solution. And this is really even after the commitment made at the last COP. But if you really look at the global, I would say, climate finance architecture, this is almost unchanged in the last years. And I feel really we are now in this moment of deep contradiction where on one hand, we have this ambitious roadmap, the Baku to Belem Roadmap, which really close for scaling climate finance up to 1.3 trillion. And but on the other hand, we have those really, I would say, starking numbers around fossil fuels. And just in 2024 alone, for instance, the banking sector is providing 600 billion to fossil fuels companies. And this is again a figure that remained pretty stable even after the Paris Agreement. So on average, the banking sector has been lending something as $550 billion. And last year, we've seen an increase to up to $600. So I would say really, as the saying goes, really, if you want really to see what someone truly values, don't really listen to what they say, but instead look at how they spend their money, actually. And if we do this right now, money is still flowing towards fossil fuel sectors and companies. And is really mainly enabled and legitimized by actors, especially the banking sector, which quite often are headquartered in some of the countries that are really trying to be claimed for climate leadership. So let me try to outline the structural problem I see, and then we can turn a little bit more in the solution and what can be done. I guess one of the main issues is really that the financial system is built, unfortunately, is taking shape around really fossil fuel finance and is really sustaining fossil fuel companies. And when we look really at the structure of the financial system, the actors which are involved in the system, the way they provide capital, the overall system is really embedded in the fossil fuel industry and is strongly resilient. I think if I look at the data over the last decades, more than $7 trillion have been provided to the fossil fuel sector, and mainly in the form of debt. That is the main source for, I would say, fossil fuels. So that means bonds and loans. Roughly 80% of these basic instruments have been taken in the form of syndication debt. What that means then, when basically a deal is too large or too risky to be handled by a single bank, basically multiple banks are pulling resources together and they share the risk. So quite often we can see a high number of banks in the order of 15 or 20 banks that are really pulling resources together really to provide the capital that is needed to really to make the deal through. But the problem with this is that literally is that syndicated lending doesn't simply enable the fossil fuel projects, somehow it really amplified them. Because when a major bank really joins a syndicate, not only lends money to the project, but it also increases the credibility of the project. It spreads the risk, draws in more capital, and it really provides to the project the financial legitimacy to go forward. And this is really what I see one of the main problems, because this structure of syndication is really what gives fossil fuel finance a strong resilience. It creates really this system of interdependence. It's really a network of banks that are really pulling resources together to maintain the industry really alive and pulling just the money that is needed. So even when we've seen some banking or some banks exiting the sector, and this has been the case, for instance, especially in Europe in the last years, in reality, we didn't see any decrease in fossil fuel finance. So even if we've seen banks like Deutsche Bank, Credit Suisse, who have been really decreasing their exposure to the sector, actually, when we look at the number of the total fossil fuel finance, it's always the same. And that's because other banks, very likely in other regions, like Canada, Japan, United States, they simply basically stepped in and filled the gap. And this is really what they call the finance substitution effect. And unless we're really able to regulate the sector, or somehow we have the instruments that are there, the fossil fuel industry or the fossil fuel system, financial system, will still provide capital to those industries and will find new routes, new actors, and new enablers that really can fill the gap. Just like I guess before we move to the solution part, if we take really the main actors, as I said, in Europe, we've seen a little bit more, I would say, the positive signs in this direction, because literally in the last recent years, especially after the Paris Agreement, we've seen several banks, especially, as I say, Deutsche Bank, Credit Suisse, OBS, BNP Paribas, who have been really reducing quite significantly their exposure to the fossil fuel sector. We've seen a reduction in the order of 40% of those banks. On the other hand, however, we've seen actually other major banks, especially in Japan, in Canada, and in particular in the United States, where I call there are the big four, which are JP Morgan, Citi, Wells Fargo, and Bank of America. They've just been increasing literally their exposure to the sector. It is somehow this really a reflection of the different regulation that we can see worldwide, the different policy, the different even, I would say, momentum that we can see globally. Also, let me mention, for instance, JP Morgan alone in the US is holding almost 10% in terms of market share when it comes to fossil fuel finance. But somehow also, that also means that because the sector is so highly dominated by a set of influential banks, somehow if you're able really to target those major players, really we can get an advantage of shifting the behavior of some of those critical actors. That's I mean, if we come now more on the solution part, that's really what I see we can do. We can do quite a lot actually with the instruments that we do have. And I also want to build a little bit on some of the findings that have been mentioned by my colleagues before me. One of the key instruments is really the regulation, and especially financial regulation is something that we need to leverage a little bit more. And in particular, what we need to do is really to have more climate consideration embedded into core financial regulation, prudential regulation. And somehow we need really to move this more in terms of binding policy, mandatory policy. And we've seen quite a lot of activities in terms of disclosure, ESG. And despite those are really important tools because they do improve the transparency of the market, but we do really need to make a big jump where if you want to see a shift in the capital trends that we see in the market, we need to move really more into mandatory regulation, binding regulation, to which basically the financial participants are obliged to comply. And one aspect that I do think is important because of the global nature of the financial markets is we really need some of those global frameworks that are available. And the first one that comes to mind is the Basel framework. The Basel framework really governs really how banks manage potential risks and maintain the capital reserves. And we do really need to incorporate in those rules and recommendation, for instance, fossil fuel exposures, and in particular climate risk, financial risks. And this could take really the form of several really actions that we can think about. One which is quite simple to implement if we will have the political will to do it, is about to introduce basically exposures that limits that will cap somehow the exposure that the banking sector or individual banks can have towards the fossil fuel sector. So if you think about setting really exposure limits on how much fossil fuel exposure banks can hold or can increase every year, that can be really a very effective tool to limit fossil fuel finance. Also, we can introduce capital risk weights for fossil fuel assets, and we can make really more costly for banks basically to hold the fossil fuel assets on their balance sheets. That's something that I can really see every month actually, and it might really change the way they allocate capital. And then we need to do also more in terms of requiring transition plans, scenarios testing, which are more aligned towards climate compatible scenarios. I would say we start to see some of those efforts at the global level. This Basel Committee is exploring really how to take into account climate risk under their remits. But what is really important now is really somehow to translate those ambitions is, as I say, in tools, in targets that will be applied. And I guess really the secret will be really we need to make fossil fuel finance less profitable, more costly, and hopefully no longer viable. That's really the way I guess we start to shift capital. And the reason why we need those global regulations, as I said before, because the financial markets are global markets, and we need to target really global players. And the only way we can do this is not through regional regulation, which it might apply only to some specific countries, but it's more to through global regulation or using some of those frameworks that are able really to target those bigger players around the world. Then, of course, something more can be done also in terms of coordinating actions and schemes for investors, shareholder pressure that again are powerful tools. And something that also Katie mentioned earlier was about the international forums. So we do need to leverage more international forums where those discussions are happening to make really these institutions more accountable for aligning their portfolio with climate commitments. I guess this is really part of the story. And on one end, as I say, we need to really phase out or really reduce strongly fossil fuel finance. But on the other end, I guess the challenge is really more in terms of redirecting capital towards decarbonization and especially in developing economies. And because, as I say, that's where the investment challenge is going to be. If we look really by how much basically country will need to increase their current climate finance flows, the RDF values are definitely in developing economies compared to the developed world, where it's just by factor of 2 or 3, but actually in the emerging markets can be factored by 10 or 15 times the current levels. And that's also those are also the areas where, as Sangeeta rightly point out, where resources are not available. The financial markets, financial assets are just not there. So those are countries which are constrained at domestic level, but also at the international levels, they find it quite hard to borrow and to attract capital. So I guess really this, if we're thinking more about the Baku to Belem roadmap, really must go beyond targets and it must really build concrete mechanisms that are able to redirect finance, that are really able to deploy the most effective instruments in terms of de-risking and in terms of really crowding private capital, especially in underserved markets, where there are really a set of risks that are all basically playing together and are really compounding and are making really hard, really, as I said, the cost of capital is increasing strongly and are really making hard for these countries to attract international investors. And I guess also quite important is in this direction to boost also domestic capacity in terms of the domestic financial institution, development banks, which ideally it could be if they could deploy a similar syndication nature for energy projects, renewable energy projects. I guess I really would like to close very quickly in terms of a final thought about really finance and policies. I guess really finance is really shaped by really rules, incentives, powers, and the regulation at the global level. And in turn, the way really capital is allocated, it does determine the kind of the energy system we are going to have, our infrastructure, and in the end, they will shape the economic system in which we live. So I guess really if we don't take the commitment to redesign this global climate finance architecture in order to make the switch from fossil fuels to low carbon assets or basically shaping flows to go basically towards adaptation, resilience in emerging economies, we won't really reach those targets and we won't really make the best use of finance. So I guess really the challenge it goes really in about rewriting really the rules of the system from Basel to the bond markets so that capital really flows towards the place of the people who need it most. And I guess really this will be the main goal and the challenge of the journey from Baku to Belem.
Wonderful. Thank you so much. I think that was a big sort of piece of this larger puzzle for how we capture, I think Sangeet talked about 500 trillion in the global financial system, how we actually think about redirecting some of that towards greener activities. And I think all of these pieces will form parts of this Baku to Belem roadmap. Of course, there are a lot of differences among how countries view a lot of these issues. We have engaged on Article 21C from the perspective of developing country groups, and there are concerns about how some of these recommendations may affect developing country financial systems, whether or not they will create conditionalities for certain types of finance to flow into countries who need, let's say, energy access. But again, that's perhaps for a separate conversation. So I think all of you have done a great job of already providing some of the areas of impact that you think are most important. But I want to just having had this full set of what I think is a very well-rounded conversation, I'd like to come back to each of you very briefly, and please, if you could just keep your intervention to maybe 2 to 3 minutes, as we are grappling with this process of the Baku to Belem Roadmap. Our central goal here is how do we get finance flowing for climate action to developing countries in a way that it is accessible, it is additional, it is not exacerbating the debt crisis in a lot of developing countries. I mean, this is our big complex challenge, I think this year and in the years to come. So I'd like to come back to each of you for any specific concrete either windows of impact or actions or particular spaces that you think should be focused on by civil society governments to help us achieve this goal. So what's the sequence that we should follow? I know that in our run-of show, I had put you in reverse sequence. So Nadia, would you like to go first, or do you have a preference to go a little bit later?
No, it's absolutely fine. Thanks a lot, and very happy to continue the conversation. Yeah, thanks a lot. Indeed, I guess I very quickly I just want to mention that the challenge is really to mobilize capital at scale quickly in basically parts of the world where basically finance is not there and they're really found difficult to borrow internationally. That's what I define also a sort of climate investment trap, which is a situation or a self-reinforcing cycle in which really high perceived risk, they will lead a high cost of capital, which do prevent basically countries to invest and really to build resilient system that can reduce their vulnerability, dependence on fossil fuels, underdevelopment, and at the end they are really reinforcing the perception of risk. So that's really the context that we are talking about. If finance can be really a strong lever. So for me, one of the key issues to address is about the how we basically rethink the aspect of mitigating the risks that are there. As we've seen, really, the reason why capital is not flowing is because the high level of perceived risk and the fact we do need to address them effectively. And if we do this, we can sort of activate some positive cycles of investments that can really scale up quickly. And this will happen when we have basically moments where the right mix of policy intervention can shift the country sector from being too risky to investable. And somehow one of the analysis that really I'm trying to lead is about really not looking at these individual risks in isolation, but actually look at how risks compound, how basically risks interact in the country, and try to look for the nonlinearities that we can see within the risk assessment in order really to try to mitigate basically those risks in a more collective way. And there are really several instruments that we can have. I guess the secret will be really identifying where multiple risks will converge and push for coordinating financial interventions. And really, I'm referring to the sovereign guarantees, the currency hedging mechanisms, concessional capital, or the determining frameworks. And because collectively, we can move really entire markets into an investable space. And the idea will be really to target effectively multiple risks at once or to reduce some level of risk that will make the country investable. And we've seen a real initiative like the ADB, which created, for instance, in Brazil, this 5 billion facility for hedging currency risk, which somehow went exactly in this direction, while mitigating currency risk, promoting local currencies, and reducing the credit risk. We were able to really to attract more international capital. So for me, it's really about the way we redesign the risk assessment. It's really about stop treating risk as a static barrier to avoid, but rather treating it as a strategic pressure point to unlock. Because, for instance, when a tipping points are activated, that's the idea. It will be, we don't just need to change the geography of investments, but we change the architecture of opportunity. And in particular, we can see the shift from finance being seen as gatekeeper to catalyst, and we can ensure really that capital flows at scale quite quickly.
Thank you so much. Sangeet, over to you.
Yeah, is there a silver bullet? Probably not, right? And I think that's part of kind of us having to think about this. I think Nadia has covered a lot of the things that we should do on the international global side. So maybe I think the one thing I would say for a lot of private finance, many emerging market developing economies are still figuring out the energy transition pathway, right? But this creates uncertainty in terms of what one is investing in. So many European banks have coal exclusion policies, for instance, right? Essentially, and also the institutional investors aren't going to EMs at large, but the ones that do also have coal exclusion policy. So if you're a group company that they want to invest in, but you happen to have some coal assets and then also happen to be doing quite a bit of renewables, often you fall out of the screening for some of that capital, right? So I think from for emerging market developing economies, if you are adding coal capacity, or if you are looking at where a peak emissions, much more in a couple of decades, right? What is the pathway for the sectors, right, that you want? Laying that out, right? I think giving and accounting for a margin of error, right? To say we might be early, we might be late, this is what this depends on. I think that will help, because currently the default setting goes to how one would assess a country on 1.5 or a transition pathway initiative benchmark or a net zero, IEA benchmark. So if emerging market developing economies don't take ownership, right? To say, okay, this is the path roughly, and this is the area under the curve, and that's the budget of emissions we've got for this sector and for this sector. And that's how our path to net zero in 2060 or 2055 or 2070 looks like. I think that would actually help, at least in terms of kind of are we assessing company equities and bonds for a lot of banks and institutional investors and bond funds and equity funds and indexes. Is there other methodologies that are available? Because currently, I think that's a seeming. I think it's a small tweak. I don't know how much capital it will mobilize, but I think it will be one of those important things to look at for kind of private finance flows in the public markets. So I would say that that's one thing that on the other side of the of this discussion that could be done.
Great, thank you. And Katie, can I bring you in for final words? Concrete windows of opportunity or silver bullet, as Sangeet has avoided outlining. But if you have a silver bullet, we'd love to hear it.
I have no silver bullet, but I have some boring technical processes that civil society could be really useful in. The first one is the Standing Committee on Finance will be looking into how to measure progress towards the NCQG. And while this will be definitely a technical, bureaucratic process, I think civil society pressure to indicate what kind of tracking that looks like, how can we push for higher integrity, additional transformational transparent flows within that measurement process will be important. I think on your question of that sort of, how can we enhance overall flows? I think as much as there is the global dimension of this, we live in a globalized economy, there are national level efforts that we can take great heart from. For example, China have managed a compound annual growth rate in climate finance of 36% in recent years, which bucks the trend. While all countries have increased, nowhere near as much as that. So I think that more learning from the macro-financial tools that China has used in being able to drive its financial system towards a green transition, I think would be helpful, particularly in Annex 2 countries who hold the greater responsibility according to the Paris Agreement and the Convention. And I think to this end, there is something for that we've not talked about too much, but is this, we've talked about MDBs, but we've not talked about the greater network of public development banks, of which there are more than 500 around the world, overseeing assets around about the $23 trillion mark. Many of them are in the South. And I think that as anchor institutions rooted locally and with better support from MDBs could be enabled and empowered to be local anchors for stronger climate finance rooted in national development plans. But that takes me to that development plan sort of dimension, which is that as much as we need to enhance the supply of climate finance, we also need to create the strong development coordination and holistic capacities. Now, climate doesn't happen in a vacuum. It has to happen alongside progress on other development indicators. This is extremely important for developing countries who are facing increasing levels of poverty, increasing levels of inequality. We can't leave the development aspect out of that. And so enhancing these capacities, which have been eroded, particularly with conditionalities and influence from the international financial institutions who encourage an agenda of liberalization, privatization, or deregulation. This has eroded national capacities to be able to mount national development plans and planning. And ultimately, a transition is a big planning challenge. So strengthening those capacities, strengthening the ability, whether you're calling it country platforms or something else, to be able to create these holistic climate-aligned development plans that can have the investment capacity needs within that in order to sort of align and coordinate your national and international investment flows, I think is a critical part of that. But to balance that, we also need to continue putting pressure on the multilateral level, right? We can't forget the fact that commitments have been made, results have been disappointing, and we can't wait till 2035 to have $300 billion in overall financial flows, in external financial flows for climate finance. As much as DRM might have some role to play, there is a ceiling on that, particularly when we're looking at debt sustainability, and particularly when we're looking at the development needs of many countries. Some countries will not need any external support. Many countries will need a huge amount of external support. And so maintaining that pressure is important. And then the last thing I would say, sorry, I've definitely taken more than 2 to 3 minutes, is I would encourage civil society to look ahead. We have outlined some of the moments in the current year, but we need to be thinking about 2026 and of 2030. What are the pipeline of things that we need to see? Because ultimately, we are off track because of political cycles and short-term thinking, and civil society can be that critical buffer in providing that long-term thinking and influencing that can hopefully encourage our member states and political forces to stick to our commitments and meet 1.5.
Amazing. Thank you so much, Katie. And it definitely wasn't too long. It was super relevant, and we really welcome your insights. So that was a very rich discussion, and thank you so much for giving us your time and sharing your research with us. We got a whole lot of questions in the Q&A, and I see that we have about 6 minutes left, so we can't get to all of them. But I've picked 3 that I just want to throw out to our panelists, and with a show of hands, feel free to address any of them, all of them. I leave that up to you. So there's one question, and this is actually also selfishly, it's a question that I have as well, is that the African Union Commission is currently planning to establish an independent credit rating agency, and that they hope will more accurately reflect sovereign risk in Africa. Do you think this might succeed, and what are the challenges? So this is the first one. The second I'd like to throw out is there's this question around NDCs versus climate finance. So on one hand, developed countries have shrugged off their responsibilities on climate finance. On the other hand, there is increasing pressure on developing countries to enhance their mitigation goals. In this scenario, how is India navigating the challenge? And do you think the climate finance deal at Baku will influence India's next set of NDCs? I will zoom this out and pose this to you as maybe the global south and the question of how developing countries can balance this. And the third one is a question on how to overcome or address concerns that maybe the business case is not clear for 1.3 trillion. Could there be transparent communication of lives saved by this investment, expected livelihoods protected, and maybe supply chain resilience maintained from adaptation investments? Or does this already exist? I think this is an interesting framing of kind of making the climate issue more investable or attracting more money for it. So yeah, throwing these three questions out, I welcome any of our panelists to tackle any of these. So would anyone like to volunteer?
I'm happy to step in on the first point because I really like the first question, the rating agencies, and also because I've been done some work in our group at UCL around rating methodologies and whether or not there are potential biases in the way basically they are built and whether they put in a sort of disadvantaged position developing economies because they're not really valued their basically potential. And an interesting research that's been doing is really kind of identify the main components behind the rating methodologies and what really drives the final rating. In most of the cases, really, okay, the fundamentals, so the macroeconomic conditions, the PIB, the inflation that is there. But actually, when we were trying to play around with some data in terms, okay, what if we had some variables that actually they capture the current low carbon transition, the policy framework, the installed capacity that most of developing countries have? And then what is we've seen actually a kind of a slightly jump, especially for some countries which are at the forefront, like India, Chile, Brazil, in terms of this potential, in terms of really a bit of jump in the grade, and those countries could be actually regraded positively if a more inclusive assessment is taken into account. Now, whether or not this is going to work for Africa, of course, it's an open question. It's hard to say because there are some implementing challenges, but definitely I do believe this is really the right step to take in terms of having more this really inclusive rating and assessment that really can capture the nuances of the countries and their potential along the more standard macroeconomic dimensions that are usually captured in rating methodologies.
Thank you so much, Nadia. Any volunteers for any of the other questions or any other comments? Katie, Sangeet, putting you on the spot.
Sure, I can come in. I mean, I think that the point on the finance and the impact on the NDCs is really prescient. Already, many NDCs for developing countries are conditional on adequate means of implementation. That means, you know, finance, capacity building, and technology. And we've seen the underachievement on all of these fronts. So we are in a difficult position when we are talking about ambition for mitigation in developing countries, especially considering that for many developing countries, the priority is not mitigation, but expanding energy access. Because if we just take the continent of Africa, more than 700 million people in Africa do not have access to electricity. So this is an extremely challenging scenario. And I think that this is why we have to turn over the way that we are, the risk is being assessed, not on the financial side, but in terms of for the negotiation side. The risk is not, thinking about, creating too much room for countries to not do their homework and to not deliver strong NDCs. The risk is not having enough support for them to be able to achieve them. So this needs to be a message that continues to be carried and continues to be encouraged, because ambition is not enough in the Annex 2 countries either. We're still not seeing, we're seeing many countries not meeting their targets, many countries not grounding their targets in an analysis of what really needs to be done step by step in order to achieve them. So this is a global problem. The other thing on that last point about the business case, I'm not really sure what to say to that, because I don't know what more developing countries need to do to communicate the challenging context in which they're in. You know, we had the loss and damage negotiation a couple of years ago, which, you know, when we look at the stark realities of lives lost, livelihoods lost, dollars lost, you know, this is the climate change is here, the crisis is unfolding, and the business case is that we will all have a more prosperous world if everyone can tackle climate change together. And I think it's civil society has an important role in carrying those messages to your leaders. I'll stop there.
Great. Thank you so much, Katie. And Sangeet, would you like to come in for any final words, or also no pressure? I did put you guys on the spot.
Maybe just two very quick comments. I think just to follow up on what Nadia said, I think this is a very interesting initiative by the African Union on the credit rating agency, and I think the work at Nadia's group, there's other work, and I'm looking at some of the rating methodologies. So I think if there's an improvement in or at least a counterfactual that's presented in terms of what are some of the things these methodologies can include, that's a great start. However, I think, and this is where I think civil society can really have a lot of impact. At the end of the day, when someone is using a rating, they're buying the rating, right? So if you use a Moody's rating, you're paying a subscription service to get the product rated, right? So so the people that you're trying to attract finance from, right, need to be willing to accept the rating provided by the new credit rating agency. And it should be, and there are some, I think, implicit Basel rules, not explicit, right, around what those can be. And I think the point in case is South Africa, where there is a local credit rating agency that can only rate South African sovereign bonds, right? So I think there are things around that, but I think the conversation on why they should accept these other ratings and they are comparable, etc., that can be, I think, you know, a place where civil society can play a role in highlighting that conversation, and also then, you know, I think taking this to multilateral fora to talk about that. And I think, and I'll echo what Rahul Tongia has said in the chat. I think on the 1.3 trillion, I think, you know, the numbers are very large. I think we really need to talk about the quality of finance as well, not just the quantity of finance. I think this is very, very important. We can get lost in the mobilization numbers, the ratios of MDB money to private money. I think we really need to talk about kind of what was the intended purpose of what kind of capital, and did it achieve that, right? And I think having a sense of clarity on that, and the quality of, you know, where that lands up, I think is very important. More important now than ever, given the context we are in, to stretch every dollar or euro or pound as far as possible, right? And to have most impact. So I think I would just echo that. And I think, again, there's work around that that many people are doing.
Yeah, 100% agreed. And I think for us, that was one of the big missed opportunities, among others, in the Baku decision. Interestingly, there were earlier drafts of the decision that actually did reference a particular subcomponent that should come from public finance, that should be highly concessional or leaning towards grant-based. But in subsequent drafts, a lot of that nuance was wiped out. But I think quality remains foremost, and an issue that needs to keep being amplified. And CSE couldn't agree more. So I'll wrap up. We're 3 minutes over our time, but this has been a fascinating discussion. I've personally been very excited to get all of you together and hear you speak on this issue. We will keep engaging on the Baku to Belem roadmap for the rest of this year till Belem COP30, as I think many of you will. And we are keen to kind of continue these very critical conversations. And when I say critical, I mean conversations that are actually dissecting a lot of the narratives and really ensuring that our stated goal of ensuring that money flows to developing countries is actually kept in focus, and there isn't it isn't getting buried in a lot of the noise that does tend to surround these things. So thanks to everybody who joined us. Thanks to our 3 panelists, and look forward to chatting more and continuing the conversations with all of you. Thank you, everyone.
Thanks all.